So, welcome to week 10, lecture 1 of probability theory with actuarial applications. Today, we are going to put ourselves into the shoes of an actuary, and we will try to use the theory that we have discussed from weeks 1 to 9 and integrate that theory into our actuarial setup. Okay. So, that is the game plan of today. That is why the lecture title is the language of insurance models. Let us begin. So, what we have studied in last 9 weeks, let us quickly recollect. In weeks 1 to 5, we started with the language of risk, which we defined to be probability, and the axioms were the grammar of that language, right. And after that dealt with various random variables. So, some concepts associated with random variables like PDFs, PMFs, CDFs. Then we looked at multiple random variables together, that is called joint distributions. Then we saw transformations of these random variables, y is equal to g of x, and then we had some glimpse of deductibles in that. After that, this weeks 1 to 5 actually laid a foundation for base or this laid a baseline for our study. After that, we built some tools which are in week 6 we developed law of total expectation and law of total variance. These are the power tools which will enable us to navigate in a better way in the world of random variables. After that, we realized that these tools, though they are power tools, they have some constraints, typically while dealing with convolution of random variables, and therefore we defined one magic shortcut, which is moment generating function, MGF, or expected value of e raised to tx, where x is a random variable. This shortcut enabled us to navigate through convolution of random variables and identifying the distributions of the random variables using uniqueness of MGF with respect to a distribution. Once we were set with these background tools where we are actually looking at probability distributions and we are figuring out their properties, we then marched onto a journey where we absolutely don't know many things about the distribution of the random variable. However, we want to have some approximations or some estimates on probabilities. In that case, we in weeks 8 and 9 we resorted to some inequalities like Chebyshev, Markov, Jensen's. All these inequalities enabled us to give bounds without knowing anything absolutely about the random variables distribution, but by knowing some moments like mean, variance of the distribution, we were able to do a nice thing. Then came the master stroke, which was central limit theorem. This central limit theorem essentially says that if I have a family of independent and identically distributed random variables, I am looking at sum of those random variables or average of those random variables, one magical approximation formula kicks in, that the distribution of all these is again going to be normal distribution. Okay. So, this is where the power was really used, and we can actually talk about various distributions without knowing their distribution function, how they will behave if they are in bulk. That is basically the solution to that was normal distribution. In normal distribution, we need to identify only two parameters, mean and variance. Therefore, all our venture of weeks 1 to 9 relied on finding the two moments, mean and variance, and after that using all these tools one after the other or in combination of each other. So, what we will do now is we will set up a game plan for using these tools, these power tools in our actuarial setup, and this is what we are going to do in next 2 weeks. So, first we will identify how do we price a single policy and how do we model the total aggregate loss of entire insurance company? So, these are the two questions that we will try to address in these 2 weeks. So, when we are pricing a single policy, we have to look at what limits we have posed on the policy. So, a policy contract document will be very crucial. Okay. So, we already have glimpse of what all these things are. While learning this theory, we have also solved some problems. We called it as Boss problem or random sum problem. All those problems we have solved. Now, it is time for us to understand the actuarial perspective behind that Boss problem. So, let us move on to the next slide by putting your foot in the actuarial shoes. Let us do that. So, when I am an actuary, what I will worry about is the loss distribution, right. So, my question will be, okay, what will be the loss distribution of a certain random variable? So, let us look at a company's perspective, the insurer. The insurer's total loss, which we call it as S, is nothing but sum of the losses that the individual policies will have, right. So, in that case, the first question that comes, that is how many policies will come for the claim this year, right. We call that as frequency. So, that is where the first question comes, and the insurer's loss will be driven by two factors. The first factor of which is how many policies will be there, right. So, how many policies will be there, the word itself suggests that this is going to be a discrete random variable. It is like we are counting, so it is a counting 0, 1, 2 and so on, right. So, what are the named distributions we know for this purpose? So, mainly two distributions come. One is binomial, where we have explicit understanding of n, which is for fixed portfolio, a portfolio of n policies, right. So, that is the fixed understanding. If we are dealing with time intervals, first month, second month, third month, then the natural choice that comes is Poisson lambda. This is for time intervals, right. So, the frequency is a discrete random variable, and two choices which are typical to us, which we studied in week 3, are Poisson and binomial. Okay. Let us move on to the second driver of loss distribution. Okay, the claim has come. How big is the claim, right? So, we call that as severity of the claim. How big is the claim? So, in this case, we assume that money flows continuously. So, it is a continuous random variable, and the claim amount is definitely going to be a non-negative number. Okay. So, with these assumptions, we have the severity random variable x, which will be a continuous random variable with support on 0 to infinity. What do I mean by support on 0 to infinity? It simply means the random variable takes values with positive probability in the interval 0 to infinity. Do I know any named distributions on this interval 0 to infinity? Yes, I do know. Exponential and gamma alpha lambda we have already studied. Exponential is the special case of gamma alpha lambda with alpha equal to 1. So, we have this particular these two distributions which will typically arise in many of the actuarial applications. Along with that, we can have some heavy tail distribution like Pareto distribution, which has slightly heavier tails than exponential random variable or gamma random variable. Another interesting thing that comes is if the normal random variable is raised to the power exponent e raised to x, okay, then we will look at the distribution called log normal distribution. So, sometimes in problems we may come across these distributions, in which case the probability density function will be explicitly given to you. Okay. So, now let us look at how this S is composed of. We have already seen this in several lectures. It is basically a random sum, but let us derive it from actuarial perspective. So, combine these two drivers of aggregate loss model and view this S as total loss for a specific year, where N is the number of claims that occur during this year and Xi is the size of the ith claim. If I put all this in perspective, then I will come up with definition of S, which is nothing but a random sum of variables Xi, x1, x2 and so on up to xn. So, this is random sum of random variables, right. So, basically the problem here that we discussed was, we know this capital N is going to be another random variable. So, we do not know explicitly what value of N will be actually realized. That means, we do not know how many Xi's we will add. Added on the top of that is the randomness of size of the claim. So, we do not know how big is the size of each claim. So, this is what we will build now, and we will try to actually find how big will be the size of the claim on average, how big is the number N on average, and that is what will lead us to the boss problem within quotes that we discussed earlier. Now, we will see from the perspective of an actuary. Okay. So, now you look at this particular setup where we are looking at size of the claim, okay. But will insurance worry about size of the claim or what is going from his pocket, right. So, the insurer payout is important than the size of the claim, correct. So, we need to make that distinction and we need to filter this random variable Xi through that lens. That is where our next slide is important. So, we have a severity variable X, which is more complex than it looks. For example, if I want to price a policy, we need to define this severity variable appropriately. So, we will take the contrast X and Y, where X is actually the loss that is incurred to a customer, okay. We will call that as ground up loss, okay. For example, if a customer who has bought insurance, hell causes worth $5,000 damage, okay. So, he is saying that there is a $5,000 damage. This is a total damage from an event before insurance, okay. So, that is the ground loss. So, this is the loss that he has incurred. What we will look at is the insurer payout. So, this is the portion which insurer is going to pay because of the policy contract. For example, if this guy incurs a loss of $5,000, the insurer will say in a policy document that $1,000 is a deductible. So, we will not worry about $1,000. We will pay over and above $1,000 whatever amount you have incurred. So, in this case, if the event has actually happened and $5,000 are lost, the insurer payout actually turns out to be 4,000, right. So, that simply means my payout is what matters to me as an insurer, and now I need to base this Y on this X. How will I do that? So, the link is your X is going to ground up loss is going to be the input. I will feed it into a function which has these rules of the policy contract, and this policy contract will enable me to spit out the value of Y, okay, which is G of X, and G is the policy contract that is at play. So, how will I build this around? So, what am I actually worried about? Am I worried about sum of x1 plus x2 up to xn ground up losses, or am I worried about how much is going from my pocket? Definitely I will be worried about my pocket, So, the true aggregate loss model will effectively become S equal to y1 plus y2 and so on up to yn. The randomness of n is still intact, and now we have two competing versions, Sx which is actually a ground up loss, and Sy which is the insurer payout, the total payout of the insurer, right. Now, why am I worried about this? Because based on this I have to determine how much premium I should charge to every insurance client, right. So, my goal is to determine the pure premium from the whole portfolio, which will be expected value of S. Okay. So, how will I determine this expected value of S? Again we will go back to our theory, week 6 power tools, and we will talk about law of total expectation, and therefore the total expected aggregate payout will be expected number of claims into expected payouts per claim. So, that is very well studied in our course, and we did this using conditioning. So, we are very much familiar. We conditioned on n and then treated this as finite sum, and then because of this IIDness of random variables, we were able to say that it is n times that expected value of y, and then we took expectation and we got this formula expected value of n into expected value of y. So, what is our game plan now is, once we understand this expected value of S and we know this will enable us to determine pure premium, we will attack individually n and y. So, expected value of n, which is the number of claims, those are very easy, kind of easy to compute. However, the severity of the claim may differ significantly. So, expected payout per claim, which is severity after policy, will be the hardest. So, what we are planning to do now is, we will execute a game plan like this. First, we have this master formula, expected value of n into expected value of y, which defines the roadmap. If we are looking at expected value of n, we will simply deploy two things, one Poisson case and another one binomial case. So, what is important to me is, what is the mean of Poisson? It is going to be, if it is Poisson lambda, it will be lambda, binomial NP, expected value of n will be NP. But the next part, which is finding the value of expected value of y, is going to be tricky, and for that we need to liberally use the law of unconscious statistician or LOTUS, which we derived in week 2. It is expected value of y, which is integral 0 to infinity gx fxx dx, right. And week 10, this full week, is about evaluating this value for different gx's and what are the complications that are involved. Once we do this, and once we combine this with expected value of n, we have complete control over expected value, which is the average. But I am also worried about how much fluctuation in this, around this average happens. For that, what do I need? I need to tame variance of S, which is the component of week 11, and for that I will use the law of total variance that we derived in week 6, which says variance of S is nothing but expected value of n into variance of y plus variance of n into expected value of y squared. That is the beauty. So, we can actually, if we can execute this game plan, we can master the boss problem. Before going to boss problem, let us look at some technical terms that are involved for actuaries. So, those terms are per loss and per payment. Okay. So, this is a common conceptual trap. So, when the insurer is looking at his sheet, he may come across per loss and per payment quantities. So, we need to distinguish between them. One is giving you a general loss distribution per policy, another one is giving you a loss distribution on the policies for which we paid the claims. So, let us make this distinct. If you are looking at per loss variable, which is y, right. So, for example, let us say you have observed capital N loss events xi. For some events xi is less than d and it is acting like a deductible, in which case you may not pay anything. Okay. So, your y will be 0. If x1 is less than d, y1 is equal to 0. When we are talking about expected value of y, we are actually counting this in our expected payout per loss of an event. So, it includes all these zeros and the distribution, the probability assigned to zeros, because most of them will have a 0 probability, right. Most of the people who are buying insurance may not claim. So, there may be enough probability mass around this 0 distribution. Also, because of the deductible that we are talking about, they may not hit the buffer, so no payout has gone. So, it includes all the 0 payouts and this is used for pricing the insurance. Okay. So, that is expected value of S equal to expected value of N into expected value of Y, which is what we will use for pricing the insurance. Okay. Now comes the second thing, which is per payment, and this is very important. Why is this important? This is actually counting all those policies for which the payment is actually made. Okay. So, this is the source of revenue generation. So, we are looking at y greater than 0. If y, that is the policy, is due for payment, then how much is the payment, right. So, that will be denoted by YL, and YL therefore is the size of payment given that the payment has occurred. And now you look at this expected value of YL, which is expected value of Y given Y is greater than 0. So, the essential feature of this is it is actually excluding the number of payments that we are not making, only counting those payments where a non-zero payout, the money has gone from our pocket. Okay. So, this is an important metric which is often used by our claims department and insurer companies claims department. Now, it is natural to ask a question, what is a connection between this Y, which is per loss variable, and YL, which is per payment variable. They both are connected, and we will deploy one specific technique, which is law of total expectation, to understand that. So, let us look at expected value of Y. So, expected value of Y, if I can think about it, it will be either 0 or greater than 0, right. So, I can divide it using law of total expectation. I can divide this into probability of Y equal to 0 plus probability of Y strictly greater than 0. Okay. Now, what will be this expected value of Y, because I am splitting it here, right. So, it will be expected value of Y given Y is equal to 0, correct, and when I am giving this will be expected value of Y given Y greater than 0, but what is this? This is actually YL. Okay. Now, another distinction, what will be the value of this, because Y is equal to 0, if I substitute it as 0, then it is essentially 0. So, this term will not appear, this term is actually 0. Okay. So, what I got, this is actually equal to probability of y greater than 0 into what is this random variable? This by definition is YL, expected value of YL. So, now I can see the connection. Expected value of y is actually a product of probability y greater than 0 into expected value of YL, right. So, that is the connection that is very crucial. So, sometimes in exam problems you may be given per payment quantities, and if you use blindly without multiplying with probability of y greater than 0, then your calculations may go wrong, right. So, always remember this link via law of total expectation, that the per loss average is per payment average times probability of a payment. Okay. So, this you should always remember. Okay. So, now that we have understood this, let us summarize what we have learned today. So, we have set up the language of actuarial models for frequency, severity and payouts. We discussed the aggregate model S, which is sum of random number of n yi's. Okay. Fine. Then what were our drivers? The first one was frequency, how many claims. Second one was severity, which is ground up loss size, and then we focused zeroed in on the insurer payment, which is y equal to g of x, and we have this master formula which is behind the scenes. Expected value of s is expected value of n into expected value of y. In the next class, what we will do is how to calculate this expected value of y for different policy functions gx. And first thing that comes is we will have a first policy function which is deductible. We will learn about it. See you in the next class. Thank you for listening to this.